Oh, wait, are you live on Instagram?
Yeah.
Oh, so I don't need to go here?
Uh,
Oh, shoot. Do you want me to cancel this one?
no, we'll cancel this. This one's already ended.
Hey everyone, welcome. Happy Friday. Welcome to our BYOB party. Okay, you want me to leave this one
Yes.
going? All right, got it. Good, because I didn't approve that angle anyways. Okay, so BYOB, we're having a BYOB party today. Bring your own beverage. Today I am having water with electrolytes because it is only noon Eastern time, 12 p.m. Eastern time. I don't like noon. I don't like when people say noon. You like to say noon.
Yeah, that's the proper way to say it.
As it's the proper way or popular way?
Proper.
I don't think so. 12 p.m. Eastern time sounds very proper to me. So as you're coming in, let us know if you prefer noon or 12 p.m. Eastern. And also let us know where you are tuning in from. We would love to know where y'all are coming in from. And we'll get started right at 12 p.m. Eastern. But as you're coming in, let us know where you're coming from. Share this out. Tag anyone you know that may want to join our BYOB party. And by the way, if you didn't already know, BYOB is not actually being bring your own beverage, booze, or any of that. It is become your own bank. We're talking about building wealth today. Okay, so if you know anyone that is not on this stream or didn't register, tag them, share it out. We're going to be talking about building wealth for generations. All right, so grab something to take notes with. Grab a pen, grab a paper. I guess noon removes any confusion, the same as midnight.
See, there you go.
Well,
Lloyd knows the deal.
But isn't 12 p.m. Eastern also clear?
It's a lot to say. Somebody might forget. Noon, nobody can confuse that. There's midnight and there's noon.
But 12 p.m. Eastern, noon at what time zone? What time zone? It could be a different time zone. Anyways, grab a pen, grab a paper, something to write with, take notes, and also make sure you put any questions that you may have in the chat, and we'll do our best to answer your questions live. If we don't answer them, which we'll do our best to answer them live, then we'll be sure to reach out to you and answer those questions. And also, be sure to stay through the end of this event because for those of you who registered, we have a gift, a free gift that will be sent to you. And we'll tell you what that is. And also, we're going to show you how to get more, how you could take the information that you're going to learn today and how you can implement it into your own finances to build wealth for generations. Okay? So, thank you very much for joining us. And it is just about noon Eastern time. I don't like the feel of it. 12 p.m. Eastern. And it is that time. So welcome to our BYOB Become Your Own Bank event. As I said, please let us know where you're tuning in from. Grab something to
shout out your city.
Yeah, shout it out. And also shout out anyone you think should be on the stream. Share it out, ask questions. Let's get started.
Yeah.
Are you ready?
Yeah, let's do it.
So how do I get the slides up, pictures?
You keep talking, I'll put the slides up.
Okay, so I'm going to tell you, if you don't already know who we are, I'll tell you who we are, why we're qualified to share this information that we're going to share with you today, and how we are going to deliver this information to you. Okay, and to begin with, welcome to our How to Become Your Own Bank event. The reason that we're doing this event is because we want to help you get the right information to strengthen your finances in your life and your business so you can truly have the life that you want to live, okay? And you can have an unbreakable financial house. We'll talk about what that is in a minute. And this information that we're going to share with you, it's taken us a long time to learn and implement. It's not widely known. It's not widely shared. Okay, so this has taken a while for us to learn and implement in our lives. And so we want to help you to be able to condense the time, learn the information, and start implementing it a lot sooner than we were able to. So to tell you a little bit about who we are, you had it right.
Yeah, but I was changing it because I didn't just want the slide to be up, so I switched it from the slide show. Are you ready?
Oh, yeah.
Okay.
All right. So, before we had this information, before we were on the same page together, we didn't always have this information. We weren't even in business together. And if you don't already know, we're Martin and Chelsea Matthews. I'll tell you a little bit more about us in just a minute. But this is our family now. Martin, me, and our son, William. And in fact, before I even met Martin, before we were in business together, before we were in a relationship, I was a single mom. It was just William and I struggled for 7 years to find a balance between financial success and family success. And I felt like I was sucking at both. I felt like I had to choose one or the other, and I wasn't doing either one great. I was either spending time with William and broke, or I was making money and not spending any time with William. And I hated it. I wanted both, but I couldn't figure it out. And I knew there had to be a better way. And I wanted to teach William a better way. I wanted him to learn the tools to be successful, to create whatever kind of life he wanted to live, not just survive or struggle through life. And so I really set out on a journey to get the right information and find out, how does money really work? How can I make it work for me? And then how can I teach my son? And I knew if I could teach my son, I could also help other people. I knew there was other people that wanted this information as well. So I read books, I went to seminars, and eventually I met a group of people who were teaching people how money works. They were making money doing it. And I was like, yes, this is what I want to do. This is it. So I packed William and me up. William packed William and myself up, and we moved to a different state. And that's where I met this guy. He was also working with this group of people, and he had a little bit more experience than me. So he kind of took me under his wing and showed me the ropes. And little did I know he had other plans of not just combining our business, but the more that we got to know each other, the more we realized our goals were so aligned and the impact that we wanted to make were so aligned that we ended up combining our business, combining our life. And now we get to help others through the things that we've learned and implemented in our life, helping them to strengthen their finances and create the life that they truly want to live. And so I'm going to show, oh, did you just take that?
Yeah, I took it off because when you're talking to somebody, that picture doesn't have to just be there the whole time.
Oh, but you take it off right when I'm about to go to the next slide. Yeah. But a good idea though, I like it. Okay, so I'll tell you a little bit about why we're qualified to share this information with you, okay? If you don't already know who we are, we're Martin and Chelsea Matthews, and we're founders of M Wealth Group with clients in 47 states. We have a combined 21 years experience, and we lead an agency of associate advisors. We've held multiple licenses in the fields of investment advisory, securities, and insurance. And we're also co-authors of this book, Let's Fight About Money, helping couples communicate about money, handle conflict, and build an unbreakable financial house, which, like I said, I'll go into that. What is an unbreakable financial house? But before we get to that, a little bit more about why we're qualified to share this information with you today is we help individuals and businesses properly use cash flow to create personal wealth in their life and their business. Our mission is to deliver measurable results to help our clients build an unbreakable financial house and business so they can be free to live life by design. So, what the heck is an unbreakable financial house? It means an unbreakable financial house means you can handle anything that comes your way financially. Your finances are unbreakable, unshakable, no matter what happens. But it's more than just being able to handle things financially. It means that you can create the life you truly want. You can make the impact that you truly want in your life, your family, your business, your community, and beyond, and really reach your full potential, because we were all designed with gifts and talents to share. And if we're too busy worried about making the right financial decisions or just getting by, then we're not really sharing our gifts and talents that we were meant to share. So that's what creating an unbreakable financial house means. Now, I told you who we are, why we're qualified to share this information, and now I'm going to tell you how we're going to deliver this information to you. This is very important. Knowledge, responsibility, and control. Okay, we're not just telling you we're so smart. Okay, now how do I change it so that it's not the slide?
I'll do that part.
Okay, thanks. So knowledge, responsibility, and control. We're not just telling you, hey, we're so smart, we're experts, listen to what we say, do what we say. No, we want to empower you to have the right information to increase your knowledge so that you could take more responsibility for your actions and know that they're the right actions for you. And when you do that, you have more control over your life, your money, your results. Okay, we want to empower you to have the control to create the life that you want. All right. And now it confuses me trying to go back and forth between the slides.
Yeah, we just say you want to slide back up.
Okay, slides back up, please. All right. And okay, great. So what we have discovered is that everyone is building a financial house. Okay. Some people have a financial shack. Some people have a financial mansion. And some people are in between. So the key is to identify where you are, what kind of financial house you currently have, what kind of financial house you want to have, and what are the steps, the exact things that you need to do to get from where you are now to where you want to be. Now, there are 6 building blocks that make up your financial house. I'm going to briefly go over them, and then I'm going to tell you which 2 we're going to focus on and deep dive today. And Mr. Matthews is going to take it away. He's going to go deep diving into these 2 building blocks. Okay, so building block number 1 is cash flow, the money coming in and going out of your household. Always focus on increasing your cash flow. Okay, building block number 2 is debt management, understanding the difference between good debt and bad debt and how to use good debt to build wealth. Building block number 3 is reserves. This is so key in having an unbreakable financial house and really being able to withstand anything that comes your way. Having those reserves so that when things like a worldwide shutdown happens, you can continue going on. It doesn't stop you. It doesn't phase you because you have built up massive reserves. Okay, building block number 4 is proper protection. I always want to just go right to the building block. Okay, building block number 4 is proper protection. This is having the right types and right amounts of insurance, specifically life insurance. This is how you ensure the financial survival of your family and your business. Very key piece to your financial house. Building block number 5 is build wealth. Okay, we all want to build wealth for generations. A lot of people talk about building generational wealth, but how do you actually doing that? How do you actually do that? And how do you protect yourself from the enemies that will destroy your wealth? Okay, and building block number 6 is build legacy. This is having the right documents in place so that that wealth that you built for generations actually does what you want it to do. Okay, so it's very important to have all these pieces in place that will help you truly have that unbreakable financial house. Today, we're going to focus on building block number 4 and building block number 5, proper protection and build wealth. And when you strengthen these and when you implement the strategies that Martin's going to talk to you about today, it helps to strengthen your whole financial house and it impacts all the other building blocks as well. Okay, so make sure you have something to write down, notes, and also be sure to put any questions you have in the comments, okay?
All right. So let me just say hello to a few people. What's up, Brandon? What's up, Lloyd, Adrian, Iggy? Iggy's my nephew. So
what's up, Brandon? Let's go.
Onochukwu, O'Neill, what's up, guys? Hey, thanks for commenting where you're from, Monica, Miss Deb, Regina. So look, if you guys have any questions along the way as I'm talking about this, feel free to drop it in the comments. and then we will answer them as we go along. So the topic for today is we're talking about how to become your own bank. Why is that important? And what you need to do to make sure that you're building an unbreakable financial house. How all these steps and tools will help you. What's up? What's up, MAL? I can see the name on here on the Instagram thing. So let's dive into it. Now, it's very important to understand the role financial education or financial literacy plays in the world today. Because if you're not financially literate, it's very easy for institutions, for bad actors, all these people to take advantage of you. So that one of the greatest things you can do is increase your knowledge. It's why we always try to empower people so that they can increase their knowledge so they can be able to think and rationale through things for themselves. So when it comes to building wealth, there's a big problem. You're not being educated about the enemies of your wealth. If you don't know where the enemies are, where the pitfalls are, it's very easy to get trapped and fall into going backwards financially. So it's why education around money, finance is extremely important. They don't teach you about it in schools. It's difficult for your parents to teach you about it because a lot of times your parents don't know. My parents didn't. So they couldn't really, what could they teach me? They can't teach me something they don't know. How can you teach someone something you don't know yourself? So you being empowered on the subject of money and finances doesn't just impact you. It also impacts future generations, people around you. That's how one of the ways you impact and help your communities. So one of the things we educate people on, and this is why people choose to take over the banking functions of their households and their businesses in a more deliberate way, is because there's enemies of your wealth. The three biggest ones are, number one, taxes is the biggest bill that you have. It's the largest bill you're ever going to have, unless you strategically plan to eliminate it. And there's ways to reduce it. Maybe you don't get rid of all of it,
Legally.
all of it, all the time, but you can reduce taxes legally. The government does publish guidelines on how to do so. It's called a tax code. And so understanding how things work helps you minimize your taxes. Number two is inflation. We've been talking about this. Chelsea and I have combined 21 years in the financial industry. We've been talking about this for a long time. Sometimes people don't always feel the effects of inflation, but you're feeling it now. When the money supply is inflated, that's where that comes from. When more and more money is printed, it inflates the money supply. When that's inflated, the prices of things have to rise up because the people selling stuff know that there's a lot of new money supply being there. So they got to raise the prices to match up.
It doesn't inflate the value of money.
So printing more money doesn't inflate the value. It just means that now everything costs more. So number three, market losses. Doesn't matter which market you're in, whether it's you're in the stock market with your retirement account or investing in the crypto market or real estate, whatever market that you're in, that you're putting money into, you have to understand, how do I minimize losses? How do I domesticate risk so that I can give myself more chances to win than I have chances to lose, right? So market loss is one of the biggest enemies of your wealth. So what we'll do today is we're going to show you a strategy that wealthy individuals, banks, big corporations use to defeat these three enemies. Something you can do for yourself is just, people just need to be better educated about it so that they can do a lot of the same things. Now, when we call the strategy become your own bank, because one, it implies you are taking more responsibility for that function in your household. Doesn't mean you're going to go and open up Bank of America on a street corner. It means taking over the banking function of your household. And how do you do that effectively to benefit yourself more than is benefiting some other institution? So using a strategy leads to clarity, certainty, and control in getting what you want. You want to be clear exactly how am I going to get from where I am to where I want to be, whether it's finances, whether it's fitness, finances, is whatever. There's always got to be some kind of clear path, or that you can go from where you are to where you want to be. Like, I work out with a trainer. Why? Because that guy has results that I want. So I work out with him so he can help me have some clarity on what I need to do to get there. And I can increase my certainty. The more I increase my knowledge, the more certainty I have. And I want to have control. I don't want to be the effect of Wall Street or the effect of negative things happening. I want to be in control in getting what I want. I want to live my life by design. I want to design and orchestrate my life not just be the effect of a bunch of randomness happening to me. So in order to understand how to become your own bank, and the steps you need to take and different things you need to do, you first have to understand three different ways to view money. And as I go through this, I want you to think about how you view money, how you think about money. A lot of this stuff that we're talking about today is going to be you looking in the mirror and looking at how do I operate? How am I running my household? How am I running my business? All of those kinds of things. So three ways to view money. Number one, you can view money as a spender, somebody who gets money to spend. View money as a saver. You can view money as a banker. So we'll talk about the differences here. So the spender, what is he? How does he see money? Money is a way to buy stuff. I used to be a spender. I get money, I want to buy crap. I get money, I want to buy stuff. I just go to the mall, have nothing that I actually wanted to buy, but I just went because I wanted to buy things. I couldn't hold on to money. I would just get it and spend it, right? My bank account was always at a certain level. Anytime I went above that level, guess what I did? I spent it down, right? That was just my comfort level and what I had. This was many, many years ago. So there's a lot of people who view money as a spender. However, every time you purchase something, it costs you interest. I want you to think about that for a second. Anytime, if you're a spender, that's how you view money. Money is made to be spent. That was the false data I got when I was a kid. Somebody told me money is made to be spent. So that's what I did. I would get money and spend it. But every time you buy something, it costs you interest. Whether you pay cash or you finance it, it costs you interest. When you borrow money to buy something, you pay interest. When you pay cash, just because you willy-nilly give up your money, when you pay cash, what are you doing? You're giving up interest you would have earned. You understand? It costs you interest. If you are a spender, if you view money as I just spend, every time you borrow to go and you borrow to go take that trip, you borrow for whatever it is you borrow for, you're paying interest for that. And when you pay cash, you give up interest that you would have been earning. I want to talk about how do you do both? How do you still spend your money? How do you still buy stuff and still have your money earning interest at the same time? I'll show you how to do that. So here's an example. We're going to talk about a car a lot throughout our talk here. It's kind of a theme. But let's say you go, the spender wants to buy a $30,000 car every 5 years. If every 5 years he goes to buy a car at 5.5% interest, so 5.5% interest, after 11 purchases, buys different cars 11 times over every 5 years. After 11 purchases, the person who borrowed money has spent $378,000 on cars at $30,000. My car costs more than $30,000. So you understand, people may end up spending way more than this on cars. The cash buyer, so that's what people think. Cash buyer, they think, well, I don't want to pay interest, so they pay cash. The cash buyer has spent $333,000. That's $30,000 per car. 11 cars over his lifetime, $330,000 in his lifetime just on cars. So this makes people think it's always best to pay cash, right? They think, oh, this guy over here is going to spend more in, can I go backwards? Yeah, there you go. All right, so cash buyer thinks it's better to pay cash because I want to save some interest. So the saver, he's like, I don't want to pay interest. I want to save money and pay cash. So the saver first, what's the thing you have to do when you're trying to pay cash? You first have to save up the cash. You got to take the time to save up the cash. Then you go and pay for it. Now, the banker, so the cash buyer, he goes and pays cash for the car, and then what happens? He's back at zero. He saved this money, spends on the car, he goes back to zero, right? So the cash buyer and the one who borrowed, both of them end up back at zero. The guy goes into debt, and then he has to get out of debt, be back at zero. That's when people say they're debt free, that's a lot what they're talking about. It means they got into debt and now they're back at zero and they paid off their debt. They're back at zero debt. The guy who paid cash, he's back at zero because he's like, oh, I had all this money in cash. Boom, he spent it. So now he's back at zero. You understand? Both of these people end up back at zero. Very important concept to understand. How do I not end up at zero?
Except for taxes.
Except for taxes. Taxes, you want to be zero. Just ask Elon Musk. And then he had to pay $11 billion this year. We'll even talk about him too in here. So understand that concept. You get back at zero. Build a Brinks truck. Adam said build a Brinks truck. Yeah. So knowing that earning interest, the banker, how does he look at money? He looks at it and is like, look, earning interest is more important than paying interest. I'd rather be earning interest than paying interest. The banker doesn't say never pay interest. That never says that. The banker, how he thinks about it, is like, how can I earn more interest than what I have to pay? That way I'm coming out ahead. You see, banker's not getting back at zero. Banker's trying to keep staying ahead. So banker always keeps his money working. This is just how bankers view money. What they do is they say you make a deposit into the bank, which is basically you lending money to the bank. I don't know if you realize that. You make a deposit into the bank. You lend the bank money through your savings account. They pay you interest, a very, very tiny bit of interest
It's not a very good
when you lend them
exchange.
money through your bank account. They take that money and they lend it to other people at much higher interest rates. If you go back to that same bank and you want to borrow money, they will lend money to you at a much higher interest rate than they're paying you.
That's a good exchange for them.
That's a good exchange for them. Your debt is an asset to the bank. Realize that. So understand, you have to start looking at money the same way. The banker isn't saying, I don't want to pay anybody interest. The banker is saying, how do I pay them low interest and then use that money to make higher interest? This is why billionaires who can easily pay cash often get mortgages. Because billionaires understand, I can pay cash for this property. But instead of paying cash for this property, I'm going to borrow money. Most people think billionaires don't borrow money. There's no billionaire that's debt free. You can look up any billionaire. There's no billionaire that is debt free. All of them borrow money. You see, they look at things differently. There's no billionaire that is debt free. Either the business has debt or they personally have debt. There's no billionaire that is debt free. I'll say that again. There is no billionaire that is debt free. They all have debt in some form of fashion, whether it's through their company or it's through them as an individual. So understand, because there's a very simple reason to do that. So Chelsea's going to go into this part here and explain to you why they do that.
Okay, so check out this article here. What Beyonce and these billionaires have in common: massive mortgages. America's wealthiest homeowners pay banks like Goldman Sachs hundreds of thousands of dollars monthly after borrowing millions to finance home purchases. Just like Martin was saying, these billionaires, they became billionaires because they make smart money moves. And they understand that it's smarter to keep your money working than to deplete it or sell their assets. And they take on these mortgages while their money continues to grow. So you got to pay attention. Like Martin said, most people think billionaires pay cash for everything, but they don't. So you got to look at why and how can you apply it to yourself. Here's another article. Mark Zuckerberg, he's got a mortgage, and not only does he have a mortgage, he refinanced his mortgage. So not only did he do all the paperwork for one time to buy the home, but he refinanced it and did all the paperwork again, when he can just pay it off in cash in like 2 seconds. If you've purchased a home or refinanced a home, you know there's quite a few pages involved and quite a few signatures involved, and you can't just DocuSign everything. Then you do have to sign with your hand. So why would he do that? Because he knows that it's smarter to keep his money growing and take this mortgage, take this loan at a smaller amount than he can grow his money.
So look, Warren Buffett, a lot of people talk about, oh, Warren Buffett owns his house. Warren Buffett doesn't just own one house, guys. Warren Buffett owns multiple properties. He lives in one house. He owns different properties. Even Warren Buffett borrowed money to buy the property, right? Even Warren Buffett has debt. So the question for you, as we talk about this, and we talk about how a banker views money, here's a question for you. If your money is earning 4%, so you got your money wherever it is, imaginary account, doesn't matter what account it is. Just this is just a concept to understand. If your money is earning 4%, would it make sense for you to borrow money at 6%? So I'll let you guys drop in the comments. What do you guys think? If your money is earning 4%, does it make sense to borrow money at 6%?
And also, when we're talking about, these billionaires putting their money to work, keeping their money working, and borrowing money at a smaller amount so their money can grow at a larger amount. So this question, it looks like, well, I'll let you guys put your answers in the comments, but if your money is earning 4%, would it make sense to borrow money at 6%? So your money is earning less than you're going to borrow at.
Yeah, percentage wise. So just the question how it's phrased. If your money is earning 4%, would it make sense to borrow money at 6%? Now, I want you to understand. Think about there's something called compound interest, where your money is compounding, which means it's building on top of itself.
Okay,
right?
so you were going to leave it at the question. When I start explaining, you're like, leave it at the question, and then you start explaining.
Well, you're trying to
what
give
is
them
up with that?
some hints.
So
and
were
tips.
you just now?
No.
Oh my gosh.
So, all right, let's look at that question here. We're going to go back to our example of the car, and this we'll get into the how exactly to set up becoming your own bank. But you need to understand certain concepts first as a precursor to why certain vehicles make sense to do that with, right? So, if we look at a car, right, $30,000 car, paying over 5 years, loan interest rate 6%. The car monthly payments on the car is going to be $580. So that person's going to pay $34,799 for the car. Let's say this person's got $30,000 in savings. That person can say, you know what? That's $4,799. I don't want to pay in interest. So they may go pay cash for the car. Understood. Anybody can do what they want with money. However, if you look at it and play out the scenario, don't always just look at, oh, this seems sometimes something that seems evident. You may have to look at the counterintuitive side of things. Not everything that seems one way is that way. So if this person had money, $30,000 in savings, wherever savings it was in, and they were earning 4% compounding on that money. At the end of those same 5 years, they would have $36,630. That means they would have more money in their account than it cost to borrow. In this case, the person would have been better off borrowing this money, paying the $580 monthly out of their paycheck, and letting their money grow, because their money would end up farther ahead than them paying interest. So all people look at is 6% versus 4%. However, the 4% is compounding, it's building on top of itself. The 6% is being paid down over a 5-year period. So don't just look at those numbers and think you know the answer to something. Look at the entire scenario, run a scenario and say, okay, what's the best way for me to do something? That's why the banker thinks, how can I keep my money working for me and buy the car at the same time, right? So every purchase costs us interest. You either pay up interest or you give up earning interest. Now, the banker thinks, what if I could use our own money without giving up the interest that we earn? So in becoming your own bank, there's 3 steps in which a person takes. Number 1, you got to create a pool of money. You got to capitalize your bank. You got to put money away into something, into a vehicle that allows you to earn compound interest. So as you can see, compound interest is extremely important. Compound interest means the money the interest your money earned last year gets added to this year, and it keeps building on top of itself like a snowball, right? So I create a pool of money. I put that money to work earning compound interest, meaning I want to put it into a vehicle where I'm going to get compound interest, where I can just put money in and it just continues to build on top of itself and keeps going and going, right? And then the third thing is use that pool of money as collateral when you need funds. So when I need money, I don't want to take it out. I want to use it as collateral. I may want to borrow against it because I'm earning compound interest versus the interest I may pay on that. So it makes sense to keep my money compounding. I never want my money to stop compounding. So in our accounts, my money compounds. It's going to keep compounding until I die, and then they're going to go to beneficiaries, right? And so that's long term. If I live a long time, that means my money's going to keep compounding for a very, very long time. And then when I need access to capital, I can leverage it for other assets, right? Okay, so what do we use to become our own bank? What are the vehicles that we use? So to become our own bank, we use properly designed life insurance policies that builds cash. This is where we store our money into. Store our money inside of life insurance policies that build cash to use as our own bank. So here's why we use life insurance. Not because we're in love with life insurance, it's because we were trying to solve a problem. Traditional banks don't pay you a very high interest rate. It's common knowledge. Everybody knows that. Even my kid knows this, which is why he puts his money in other assets, right? So traditional banks since the 1980s have been paying very low interest rates. So if you're earning a very low interest rate, you have to look at how do I outpace one of the enemies of my wealth, which is inflation. How do I beat inflation if the bank is paying me far less than inflation? I've got to reposition my assets somewhere else. But how do I do that without losing money? So life insurance policies, the cash inside life insurance policies, you can suffer no losses. So you have guarantees and have the ability to earn compound interest. What?
Well, I was just thinking when you said about our son, I was thinking when he opened his first bank account and he put $100 in and they said, okay, so then you're going to earn 50 cents. They give 0.5% for children's accounts.
Yeah.
And so he goes, so at the end of the year, I'll get 50 cents. Cool. And at first he was excited because that's the first time he had actually earned money just for his money sitting there.
Yeah.
Then once he started learning about this and other strategies, he is like, oh, how do I put more money into this?
Into other stuff. Yeah. So anyway, we use this. There's some other reasons why it's used for that. So liquidity, use, and control. Liquidity means I can get access to how rapidly can I get access to money, right? Use. I can use it for whatever I want to use it for. My money sitting inside of a life insurance policy, I can leverage or use it for whatever I want to use it for. Control. I can control that. Asset protection. So let's say you're a business owner, you're a high income earner. Here's the thing: business owners, high income earners, whatever it is, if you have some money or you look like you have some means, people want to sue you in America. Happens a lot. People want to sue you in America. Lawyers get sued all the time. Doctors get sued all the time. So you want to make sure to have some layers of protection for your assets. So money inside a life insurance policy has asset protection by itself. Tax free means I can access the money inside of the life insurance policy tax free. So while my money is growing inside of the policy, there's no taxes on it. If I take loans against my policy, there's no taxes on that. I can withdraw the money I put in, and I can take loans against my policy, and there's no taxes on that. So life insurance has a different tax code than, say, your traditional retirement account. So remember, one of the other enemies of your wealth that we talked about earlier was taxes. So having access to money on a tax-free basis is extremely important. Collateral. That money inside of my policy is collateral, means I can use it to get access to other money. So just like a common thing is equity in your house. So you might get a home equity line of credit. The equity in your house is the collateral for that line of credit, right? So if I'm wanting to start a business and I have equity in my house and that is appropriate for me, I think I might do well in my business. I may go put the equity in my house as collateral to get a loan to go start that business. You understand? So I can put money inside of a policy. So we talk about our son. We're putting money in a policy for him. That'll be used as collateral. He can leverage that money to go and buy real estate in his 20s without pulling the money out. That's collateral. See, we're building an asset that can be used as collateral for to buy other assets. Disability benefits. So if I get disabled, that's one of the threats to your finances. If you get disabled and you can't work, what happens to your income? If you're going to work every day and earning income that way, what happens to your income if you become disabled? Your income goes away. Nobody's going to just keep paying you for not showing up. So how do I make sure my family can stay on track financially if I got disabled? So you can do that. Income for life. Some of these plans have the ability to turn on cash flow for the rest of your life, and then you can get a check every month for the rest of your life, no matter how long you live. Well, till age. Some of them are projected to age 120. Most people aren't living past 120 years old, right? So that's basically income for the rest of your life. I can use it to fund my trust. Use that vehicle to fund my trust, which is some of the things we're doing. Chelsea and I have a family trust. We talked about one of the six building blocks is build legacy. Well, part of building our legacy is having a family trust in which we put assets going into the trust for future generations. So I can use the life insurance policy to fund my trust. Generational wealth for my family, right? I can have long-term generational wealth through our various life insurance policies and the ways we're structured and ways we're using it. Bypasses probate. Probate is a process that when somebody passes away, somebody has to go to court and take the will to court. This is the person's will, and go to court, and it's called a court probate process. It's called probating the will. Well, this can be tedious. This can be a headache. What if your person in your will lives in another state? Now they got to come from their state to your state to go to court and do the whole court process. All of that is a big freaking pain and headache when somebody passes away. especially if you have assets, properties, things like that that you have to deal with. Life insurance policies like this just bypasses probate. Just send the money directly to the beneficiaries. And you can name multiple beneficiaries in your policy, and you can name your trust. So the money can go directly into your trust. You can go directly to beneficiaries, all of that, and bypasses the entire probate process. It also keeps your assets private. So here's a way we use it for real estate. So one example is, there's some arrows on the screen. I'll just kind of walk you through them. So first, we fund a properly designed high cash value life insurance policy. Let me explain something to you. This is a specialty. Your regular average insurance agent probably doesn't know how to put this together for you. Not that they're not good, not that they can't sell you life insurance for when you die. They can do all that kind of stuff. But your regular, just like when you're trying to buy a luxury multi-million dollar estate, you're not going to go to the person who specializes in selling for first-time home buyers. That's generally not who you're going to go to. You're going to go to somebody who sells luxury real estate, right? That's because that's their specialty. So part of our specialty is in properly designing and using these types of life insurance. As you can tell, not everybody sells luxury real estate for $20 million. That's not your average person. However, Chelsea and I, over the years, we have a lot of high net worth clients. And so we have clients who put six figures a year routinely, commonly into policies like this. And they build that up and then leverage it for income producing assets. Now, of course, not everybody has six figures a year to put away into a vehicle. We understand that. You don't have to put away six figures a year, but I'm giving you an example of some of the types of people we work with, because that gives you a sense of how people are using this stuff for other assets, right? So you can start with where you are. We'll talk about where you need to be financially to start using a plan like this. But we store money inside a high cash value life insurance policy. They have to be specifically designed. Not everybody knows how to design it. And if you have it designed wrong, it won't build cash. That's just how it is. Somebody may not know what they're doing, and you just go to anybody to try to do it, they may not get you set up the right way. So be very careful who you go to for stuff like this. So we design it properly to build cash, high cash value life insurance policy. We then leverage it for real estate. That real estate cash flows. We can use that to pay down leveraging on the policy, or we can just use that for our lifestyle. And we can do that with multiple properties. So you don't have to be, this doesn't have to be real estate. We have clients, hey, thanks for the love on Instagram. We have clients who leverage this to buy barbershops, right? A client of ours, he's like, hey, I like the concept. I don't know much about real estate. I know barbershops. I know cutting hair. I don't know about stocks. And I don't know about real estate. I just know barbershops. I know how to look at a barbershop, look at what the cash flow is, what area is in, and I can get my guys up to speed in there. So he buys barbershops. That's his business. So, and because he spent his whole life as a barber, that's what he knows. So he leverages policy to buy barbershops. Trucking is a great business. I love trucking. And we have a lot of clients.
Shout out to the truckers.
Shout out to the truckers, man. We have a lot of clients who are truckers. A lot of them are owner operators. So they're on the road a lot. They understand making sure their family's taken care of, all that stuff. Sometimes they want to get off the road. And so I explained to them, look, every truck you have is an asset that cash flows to you, because they may have a young guy who's like, yeah, I'm a young guy. I want to go make a lot of money driving trucks. Great. The owner might be in his 40s or 50s and he's tired. He's been putting in 20 years driving trucks and he's tired with that. So I explained to them that every truck you buy produces cash flow for you. So buy a bunch of trucks. To me, that's simple. You don't have to go learn a whole new business. Just do what you already know and what you're doing that works well. So you can still leverage this policy for any reason. So you leverage it to buy trucks, to buy a fleet of trucks, to buy real estate, to buy barbershops, to buy different things. We even leverage it for crypto, to digital currencies. We got crypto that pays cash flow every day. So all that kind of stuff, you can leverage it for whatever you want to do. Okay. Do you want to go over this part?
All right, so take a look at this article here. Bank-owned life insurance, a little-known way banks make money. So bank-owned life insurance is also called BOLI, stands for bank-owned life insurance. And this is life insurance that banks purchase. And listen to this, it's a tax shelter for banks. Okay, so we're talking about how to become your own bank and talking about how banks take your money and leverage it to make more money. And so we just showed you how to take high cash value life insurance to build wealth and leverage it to build more wealth. But also, it can be a tax shelter because the money that grows in the life insurance policy is tax free. So there's something called cash redemption value. And basically, it means that there is cash that has value and it can be used to leverage for other assets, or even shown as an asset on your balance sheet, right, for a business. So these are things that you can use in your own personal finances, in your business, and showing how very wealthy people, institutions, businesses use this. And so you can see how it's being used and how you can actually implement it into your life to become your own bank.
Yeah, awesome. So on this one here, I told you we'll show you some examples of people who use it. So this is the coach of University of Michigan, is a guy named Jim Harbaugh. So a few years ago, he renegotiated his deal with Michigan, and they agreed to a deal where they would give him a loan to buy life insurance. So anytime I was born in Liberia in West Africa.
Whoa. What?
Yeah. So anytime something seems odd, or some rich person is doing something a specific way, you always want to investigate it to find out why they're doing it that way. So that you understand, because wealthy people don't do something just accidentally, just because they feel like it. They will have advisors and different people and access to all kinds of accountants and CPAs and all kinds of different people that says, okay, this is what we want. Now let's figure out the best and most efficient way to do it. So he wanted increased compensation for University of Michigan. So instead of getting it as a salary, a lot of it just getting the money as salary as a paycheck, he says, give me a loan and I'll put that loan money into life insurance. So they loaned him in 2016 $4 million, and they loaned him an additional $2 million for the following 5 years to pay the premium on a life insurance policy. So why would somebody take their compensation in the form of a loan? Well, because loans are not taxed. So the $4 million Jim Harbaugh received in 2016, there's no taxes on that. The $2 million each year he received after that for following 5 years, no taxes on that. You understand? So what would the taxes have been on $2 million? I mean, he's already a high income.
Zero.
Yeah, it would have been more than zero. So he puts it inside of a life insurance policy as a way he structured that deal. So Elon Musk says, I don't take income from Tesla. I don't take bonus. I don't take anything. I don't take any income from Tesla. You have to understand and think through, how does the richest man in the world receive no income? How does he live? How does he pay his bills? You got to understand, the guy probably has security. The guy probably has staff, right? He doesn't just walk around the street by himself. So if you think through some of these things.
He just goes in his spaceship.
Yeah, it just goes in his spaceship, right? If you think through some of these things, you start to understand, where does he get income? How does he pay to live every day? How does he buy groceries? You think a rich guy doesn't eat? He eats. He needs groceries. So Elon Musk takes loans against Tesla stock. So he takes his income in the form of a loan. That's why he doesn't pay any taxes. So he has an appreciating asset. He doesn't want to sell off his appreciating asset, which is Tesla stock. So he takes loans against it. Rich people take loans all the time. That's why I said, show me a billionaire who doesn't have any debt. None of them are debt free. So and that's why they think it's odd when people question how much debt they have. They think like, of course I'll have a bunch of debt. What do you? Bonds. When a company issues bonds, that's a debt instrument. When a company issue a bond for people to buy, you are lending them money. That is debt. You understand? Whether it is through their company or it's through themselves individually, wealthy people, billionaires, are not debt free. So you see Jim Harbaugh owes a bunch of money in debt. He's not in debt technically, though. He put this money into an asset. He used loan as a function of tax savings because he doesn't have to pay taxes on a loan. When you borrow money to buy a car, you don't pay taxes on the money you received as a loan. You understand? It's only people who are in bad debt. That's like they put their money on credit cards to take a trip that they couldn't afford. Those are the people who are trying to be debt free. When you use debt to buy assets, they're not necessarily trying to be debt free. Jim Harbaugh isn't like waking up every day and like, how am I going to pay off this $4 million loan? I'm $4 million in debt. No, he purposely took that as a loan because of no taxes. He put that in life insurance policies. So I hope that makes sense into what I'm explaining here. All right, so do you want to do any of these parts or you want to keep going?
Sure. All right. So this one, depending on, aside from your political views, whether you love or hate the current president, just showing you what wealthy people do with their money. And the current president actually uses these policies. He's got several of these policies, and he has been borrowing from them since the 80s. Okay. So when you look at what people are doing and how you can do it also. Okay. He understands, well, he's got people that handle his finances and tell him that it's smarter to keep your money working to leverage it for other assets.
Yeah. So since 1983, almost 40 years, current president of the United States, whether you like him or not, doesn't matter. He's been leveraging leveraging his life insurance policy. He's been born against his life insurance policies for almost 40 years, right? So important to understand that all kinds of people use this.
Did you not like the way I said it?
No, I like the way you said it. So I'm going to show you. So there's a lot of numbers on the screen here. I'm going to show you. We can, if you guys want to see numbers like this for yourself, before I get to that part, we'll give you a chance to where you can see numbers like this for yourself. Here's how to know if you're ready to use this strategy. In our opinion, in my professional opinion, from what I've seen just over the years or a long time of doing this, you should have at least $6,000 a year that you can put away into a vehicle like this. If you are not there yet, that's fine. If you're not in that position yet to where you can say, I can put $6,000 a year away into a vehicle like this, then there's other things we have that can help you organize your finances, increase your cash flow, get things budgeted right so that you can be able to save more money. And then when you get to that point, then that's when you know you're ready to be able to do that. So for those of you who want to see numbers, you can go to what's the site?
6buildingblocks.com/bank.
Yeah. 6buildingblocks.com/bank. Hey, Rain, can you please drop it in the comments? So number 6buildingblocks.com/bank. We can show you a customized example for you and how numbers will look based on that. To give you some perspective, our average client puts in about $50,000 a year. Again, I realized that that's not the average person in America. The reason why we're sharing some of the information is because so that you can understand these tools and how they work, because they've been very helpful to us personally. They've been very helpful to our clients and how they use it for other assets. So that's just give you a perspective of where I think you know yourself and your finances. So you should know if you're in a position where you can put a minimum of $6,000 a year away. If you can't do that, then send us a message, and there's other stuff that we can show you that can help you get there. A lot of clients will routinely put 25 grand, 50 grand, 100 grand. We have clients who put in $250,000 a year, $400,000 a year. Again, these are not your average person in America. I understand that these are high income earners, okay? So it doesn't mean you can't apply the same concept for yourself. So maybe you do have 50 grand sitting around in your bank account. Maybe you got 100 grand, 200 grand sitting in your bank account, and you're like, hey, I know this money is not keeping up with inflation, so I want to reposition some of these assets into something like this, where I can then leverage it for other things that you want to do. So I'll give you an example here. I chose a number here that's, there's somewhere in the middle of the road there, but this is somebody putting in $12,000 a year. So you can fund this monthly, by the way. More and more of our clients are just funding it annually because they have the money sitting there, because that shows discipline. They've shown the discipline to actually store money already. So they're better positioned to become their own bank because they already got some capital built up.
And then you can leverage it sooner.
Yes. Yeah. So, and you can access money in like the next week. You can access a good portion of that money in the next week. So it's not you're having to tie your money up for many, many years. So it just depends on how much the person is putting away that allows them to do that. So this is an example here where this is a 35-year-old person putting away $1,000 a month or $12,000 a year. They fund this to age 70. At age 70, to stop. Right? You don't have to put it to age 70. This is completely arbitrary numbers, just for an example. However, here's what the projected cash would be at that age would be $1,339,000, as highlighted here in there. And also have a $1.6 million death benefit. So if they died at age 70, the family will receive $1.6 million. They're living at age 70, they got $1,339,000. Right? So Now, it doesn't mean you have to wait till 70 to use it, because that's a common question. Do I have to wait till 70? No. Like I said, we can design a policy where the person can start using the money, leverage the policy the next week if they wanted to. We literally have a person doing that this week. They funded a policy last week and they're taking a loan against it, but they put a lump sum in. They put a lump sum in for that period. So if you're funding it monthly, is a little bit different because it takes you 12 months to put that entire amount in versus if you just boom drop it in there from day one. So in this example here, and the guy in few years into the policy, the person has $104,000. Now, person can say, hey, I've got 100 grand. I want to leverage this to buy real estate. You can definitely do that. So it doesn't have to be that you wait forever to do it. And maybe he doesn't need $104,000 to use for real estate. Maybe he just wants 50. So in a few years into the policy, he's got $50,000 built up inside of there, right? So understand that this doesn't mean you have to wait until you're super old to use it. You can use it. We can design it to where if you're putting in a lump sum, it can be used basically immediately. Or if you're funding it monthly, then of course you want to build it up and then you can leverage it for other assets. So that's how one of the ways you can use it. Hey, Stacy, thank you. She said, I learned a lot with the Matthews. Thank you. Appreciate that. One of the things, though, is that people can also leverage, you can leverage your policy for anything. That's a question we get asked a lot. So people can leverage your policy for crypto. Chelsea and I have a crypto portfolio where we generate passive income
And our son,
daily.
too.
And our son, William, he's 16 years old. He realized that we matched him. We put money into a portfolio for him, and we matched him dollar for dollar. And so he saw how it worked, and a few days later, he was like, hey, I want to put more money into this thing. So he actually pulled some money out of his bank account, and he put it into this, and he generates passive income daily through his crypto portfolio. So we don't give financial advice on crypto because it's you can do your own research on crypto. And I just put the Dogecoin there because everybody knows Dogecoin. I'm not advocating Dogecoin. But we build a crypto portfolio that generates passive income. You can leverage your life insurance policy for anything. We like passive income, or recurring revenue. So crypto allows us to do that. Gives us an opportunity to do that.
So if you guys would like to see what your numbers in your financial house will look like using a strategy like this, and you're in a position that you can put away at least $6,000 a year, we would be happy to put together an example for you to see what your numbers will look like using this strategy. You can go to 6buildingblocks.com/bank, 6buildingblocks.com/bank. If you're not quite ready for that, and we have clients, like Martin said, we have clients putting in a lot more, but that's really like where you want to at least be starting at. If you can't do that, then and you would like to know like what steps can you put in place to be able to work towards that, then reach out to us, and we have some other resources available that will help you look at what is the next step, what are the things that you need to do to strengthen your financial house to be able to be in a position to use that strategy. Also, for everyone who registered for this event today, our free gift to you is a digital copy of our book, Let's Fight About Money. So after this event, you will be getting a link to download that. And
you'll get a text message with the link, right?
Yeah. A text message with the link. Yeah. So, and again, we want to bring this information to you because it's something that we've implemented in our life, in our business, to strengthen our finances, strengthen our financial house, strengthen our business, really create lasting wealth that will last for generations, and be able to accelerate the growth of our wealth, to be able to protect it from loss. And we want to help you to do the same thing. We want you to have an unbreakable financial house so you can handle anything that comes your way financially. You can create the life that you want, make the impact that you want, and reach your potential, and also be an example for your family, for your community, to improve and increase the level of your survival, the level of your enjoyment in life. The more wealth that you can create, the more experiences, more memories, the more you can help people. And so we want to help improve conditions in everyone's life. And so by sharing this information, you can take it, you can implement it, and we're happy to help you do that.
Yeah. So, and if there's any questions, we've got a couple of minutes, we'll wrap up here. But as Chelsea was saying, our mission is just really to help people and help them strengthen their finances and increase. The best thing you can do is increase your knowledge on the subject of money. When if you're trying to get money handled, the best thing you can do is increase your knowledge, because nobody can take that away from you. Nobody can steal it from you. Nobody can rob you of it. All of that. So when you become
Thanks,
empowered,
Kyle.
when you become empowered, it's very important. So it says, nice work, guys. Definitely know what you're talking about. Thanks, appreciate that. And one of the things we decided to do is we're going to start making more videos and things like that available where people can go in there and watch at their own pace, so that they can learn more from the things we're talking about. Because we learn a lot of stuff over the years, from things we've implemented, from clients we've helped, different people in many different situations, all those kinds of different things. And next, in 2 weeks, what's the date on that? The
11th,
February
February 11th.
We're actually going to be doing a webinar designed around couples, how to build wealth as a couple. How do you get on the same page with your spouse so that you can build together? How do you make sure one person is not like pushing ahead and the other person's falling behind? It happens a lot when couples are entrepreneurs. One person wants to be an entrepreneur, one person's working out a job. Whatever the situation is, even if they're both working out a job, how do you then still come together? Because that happens a lot. The person may have a retirement account at the job, the other person may or may not. Whatever the deal is, you have to figure out then how do you get on the same page to build wealth together. This is a team sport, guys. If you're got a spouse, yeah, it's very important.
Yeah, and just like Martin said, getting on the same page. A lot of times people have different views, beliefs around money and their habits. And so if we have different ideas, sometimes in a relationship you can butt heads and have money conflicts. And so how do you get on the same page so you can work together towards your goals, even if you guys have different ideas about certain things, whether you're in business together or not? It's so key. It's the difference between a successful relationship, financially, and just in your relationship, in your communication. If you guys are on the same page and working in the same direction, you can get there so much faster and accomplish so much more than if you're like butting heads the whole way. You're never going to get anywhere.
Yep. So.
And we have a gift for you guys for Valentine's Day too.
Yes. Yeah. Actually, we're gonna give away. We can tell them a little bit. We're gonna give away some cash for that.
Yeah, we'll give away a gift card for.
So you can go out to dinner. So you guys can go and have a nice Valentine's Day dinner, and then get some action afterwards. She knows me. I've been good this whole webinar. I haven't said anything inappropriate, but I tend to be the guy who says some slightly inappropriate.
Yeah, it was all
things.
before the webinar.
All before the webinar.
You were having a cooling off period during the webinar. Now that's wearing off.
That's worn off.
And he's back.
Now he's back to my inappropriate comments. I do want people to have a lot of action. It makes a difference, right? Doesn't it? Doesn't it make a big difference in your relationship?
So thank you for tuning in. I hope you guys have a great weekend.
Go to 6buildingblocks.com/bank and you can request your free illustration call. We'll customize an example for you. Our qualifications are that you're somebody who's in a position to where you can put at least $6,000 a year away. And if that's you, maybe you got more than that. That's just a minimum. A lot of people we deal with have a lot more assets than that. If that's you, go there and we'll help you design a plan that fits for you. All right, guys. Thanks, everybody.
See you next time.